We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Steve Penny, publisher of the Silver Chartist Report. Thanks for joining me today, Steve.
You bet, Tom. Thanks so much for inviting me back.
Great to have you back as always. So I wanted to start today by asking you something that you've been talking about recently. What does practical preparedness mean to you?
Sure. So, like you can easily get labeled like some kind of crazy prepper if you take some practical preparedness steps. So I think that term practical preparedness just kind of puts like a nice, it doesn't have the same connotations. But listen, our society and our financial system and the world we live in is very unstable. I mean, it's much more unstable than it's been in decades, but perhaps even anytime in the last century. So I think, a lot of us, we insure against all kinds of things, right? A lot of us who own homes, we have flood insurance, we have fire insurance. And I'm not saying you shouldn't have those things, but they're very unlikely to happen. Well, we live in a world where supply chain disruptions and things like that are a very real risk. And I think, there's some simple steps we can all take to kind of mitigate from that. And I'm happy to talk about some simple examples, but that's what I mean when I talk about practical preparedness.
Mm-hmm. Something that kind of comes to mind as you're saying that we insure against many things is, let's say, financial insurance. Mm-hmm. And something that you also recently pointed out on your Twitter is that the moment that most people will want physical metal the most is the moment that it will no longer be available to retail investors. So is that in a way, really getting that insurance before you need it?
Exactly. That's how I view physical metal primarily as insurance against reckless fiscal and monetary policy. It's just insurance. And, like I said, if you see a fire coming towards your house, good luck getting fire insurance, right? It's the same now, I think, as more and more people wake up to what's the currency crisis that I believe is coming, more and more people are going to want physical, and there's just not enough. And we saw just back in February on the first silver squeeze push, I mean, the delays and the premiums were pretty exorbitant. And I think that's an early trend. Like this is a trend that's only going to accelerate as time goes on. And if you want to go to like an extreme example, like take a look at Venezuela. Imagine how many people there would like to walk down to the coin shop and swap some paper fiat currency for silver. Like it's not going to happen. So that's kind of an extreme example. And I think we are headed in that direction. I'm not saying we go that far, but that's the direction we're headed.
Mm-hmm. And you've been kind enough today to prepare some charts for us. So we're going to go through those today for our listeners. And this is probably best viewed on YouTube because there's a lot of visual components to it.
Absolutely. Yeah. So I'll go ahead and pull up my screen here. Yeah, I started here. Here I've got a 1-year chart for the US dollar, actually just over a year. It goes back to March of 2020. And really the big thing that jumps out here is the series of lower highs and lower lows dating back to March of 2020. And we see price trading below a declining 50 and 200-day moving average. So the dollar is in a downtrend no matter how you measure it. And the institutional trading algorithms that really drive most of these markets, they tend to be in a sell the rally mode when price is in a downtrend, especially below those key moving averages. So the path of least resistance for the dollar is lower. However, we do have that support right there at 89.21. And then there's the 2018 low of 88.25 that's not on this chart. But I think once that 88.25 level is cleared to the downside, the trend could accelerate to the downside in the dollar. And of course, that would be just another headwind for the metals and commodities in general. I also
Steve, why do you say it would be a headwind for the metals and the commodities?
Oh, I'm so glad you said that, Tom. Tailwind is what I meant to say.
Yeah. All right. I was kind of confused there. I was wondering.
Thank you.
Okay.
Yeah. So you and I were talking before the show. I guess you recently spoke to Pierre Lassonde, right? Mm-hmm. Yeah, and he was talking about the gold to Dow ratio, and I had already had this chart prepared coincidentally. And what's really interesting about this chart is these are weekly candlesticks, if you can see this here. And for the last 8 weeks in a row, gold has outperformed the Dow. And I think this is a trend that I'm looking to continue. And a lot of your listeners might know that typically in bull markets, the Dow gold ratio likes to bottom at 1 to 1. It's like in 1980, the Dow bottomed at 850 And where did gold peak? 850. So that's a 1-to-1 ratio. So I think it's reasonable to expect we go back there over the next few years. And right now that ratio is about 20-to-1. So it would be reasonable to expect gold to outperform stocks by roughly a factor of 20 over the duration of this bull market.
So, Steve, as we see that long-term, let's say that downtrend, that upper downtrend line, do we need to see several, let's say, weekly or monthly closes above that to be able to really confirm that? Would you call it a breakout?
Yeah, this is not like a confirmed technical reversal yet. So yeah, you'd want to get above this red downtrend line, and that would kind of confirm a change in trend for sure.
Okay, excellent.
So I put these charts in this specific order on purpose because typically when you have a trend reversal in the precious metals sector, what I look for is for the senior gold miners to lead the reversal, right? Because that's where the institutions and big money investors go first. They want those senior gold miners. Well, that's exactly what we saw here in GDX. GDX broke out last month. These are monthly candlesticks. We broke out, came back and back tested it, and then rallied strongly in the month of May. We're speaking here on the last day of the month of May. So this is a monthly close above this breakout level. So that's very bullish here in GDX. So the path of least resistance is going to be higher highs and higher lows going forward. But of course, nothing goes straight up. But I do believe that the trend has changed. And when we look at some other charts, it kind of confirms and validates that trend reversal in the sector.
So, Steve, when we're looking at the GDX versus exactly as the next chart you have here, the GDX.J, what different roles do they play in your mind? Do you look at the seniors versus the juniors as one as a leader and one as a follower or an indicator of anything?
Yeah, so in my mind, I mentally kind of break the whole precious metals sector down into 6 subcomponents. So you would have the physical metals, that's 2, the senior gold miners, senior silver miners, junior silver miners, and senior silver miners. I think I said that correctly. So you got those 6 components, and I look at ratios between the 2 or between all 6 to see what's the most undervalued at any given moment. And right now, I think it's junior silver miners have the most compelling asymmetric setup if you have an intermediate to long-term time frame.
And why is that, Steve?
I think it's just investor psychology. You know, the big money comes into the more senior sectors first, and then this more speculative components of the sector tend to follow suit and then outperform. Like, for example, we saw back in 2019, gold broke out first, and then silver follows because it's more speculative. And I think that's what's going to happen going forward. The silver miners, junior silver miners, should continue their breakout and outperform going forward.
And just another piece maybe to add to that is that the silver miners typically tend to be more volatile too, correct?
Yes, that's a really good point. However, you know, a lot of people, I think, conflate volatility with risk. I wouldn't necessarily put it that way. I think junior silver miners, or silver in general, is, I think, less risky than gold because of the gold silver ratio if you have a long-term time frame and you can stomach the volatility. But yeah, that's a good point. Junior silver miners are much more volatile. Absolutely.
Yeah, that's actually was going to be my next point too, is you and I have spoken many times about really trying to remove as much risk as we can and provide that real asymmetrical risk reward ratio of silver. So in your eyes, that is maybe best placed in SIL.J or something like that?
Yeah, so like the ETF SIL.J, a lot of people will correctly point out that they're really not junior mining stocks in SIL.J. They're more like mid cap and mid tiers. But I think a more speculative basket will outperform at the expense of perhaps a little bit more risk. But the more junior stocks should really outperform an ETF. But, you know, there's nothing wrong with owning the ETF. You know, some people are, you know, they just don't have the time to allocate to learning the sector. They don't have time to do their due diligence on individual stocks. So there's nothing wrong with the ETF from my perspective.
Mm-hmm. So what are you wanting to show us on the GDX.J here?
Okay, so we saw GDX. You can see it's confirmed its breakout, right? Mm-hmm. So now we see GDX.J kind of following suit. It's just lagging behind a little bit, which is typical. The more speculative components kind of lag. So this is a nice breakout here on the monthly candle. And then when you look at SIL.J, even more speculative component of the sector, look, it's just beginning to poke its head above this downtrend line that goes back to 2013. So I'm looking for SIL.J to now confirm a breakout And then we'd have like really a breakout across the whole sector. The only one we're waiting on is physical silver.
So Steve, would this be considered let's say a weekly candle chart?
You know what? I actually labeled this here weekly, but these are actually monthly candles. So I'm glad you pointed that out.
The only reason I ask is how many, let's say, weekly or monthly closes do you want to see above that long-term downtrend line to really solidify that move?
So first we see the breakout on the daily chart, right? And then you want to see confirmation of a weekly close above the breakout. So then you get weekly confirmation. And then finally you get monthly confirmation of the breakout. And we have that right here. Now, it's kind of subjective to say what confirms a breakout. Different people have different rules. Some people use the 2% rule. That's kind of common. So that would be either 2% above the breakout line, or 2 consecutive candles, or 2 times the average volume. And if you get one of those 3, that kind of confirms a technical breakout. But that's admittedly subjective, but that's a good rule of thumb.
Excellent.
And then when we turn to gold here, the last couple charts here for precious metals, I just have a gold chart and a silver chart. And this is textbook right here, textbook technical analysis of gold, where you can see this big cup and handle pattern. I mean, this is very obvious to anyone who looks at charts, I should say, which means it's obvious to the institutional trading algorithms that really drive these markets. And so you see this big cup pattern here, and here's the handle. And then what typically happens, once you get a breakout above the upper rail of this little downtrend channel here, the immediate target becomes the top of this flagpole, so $2,089. Now that doesn't mean we're going to go like straight there in the next few days, but that's the intermediate term target. And I think once we get above that level, the uptrend could really accelerate in gold. And then I also have a chart for silver here. And like I said, silver is the only one that really hasn't confirmed a breakout yet. For me, that's $30.35. You could call it $30, but I like to be more conservative. And we did have that one wick on February 1st that went up to $30.35. So that's the level I'm looking for a breakout. And once we get that, I think $50 silver could probably happen faster than a lot of people think. I'm not saying it happens like in days or weeks after, but I think within a few months is totally reasonable for silver to hit 50 once that $30 level is cleared.
Steve, something you and I were talking about before we hit record here was really trying to understand the role that manipulation has on these markets, and if you can still chart in and around the manipulation that so many people talk about. So how do you see that?
Yeah, that's such a great question. I am in the camp that I believe silver is manipulated, and I think it's probably the most manipulated commodity on the planet. However, I don't think they can manipulate the overall long-term trend, but they do manipulate, on a daily, in short time frames. So I think Craig Hemke, who you've had on the show many times, I consider him a mentor. He calls it manipulation analysis. And if you kind of know the inputs into these banking trading algorithms, you can kind of predict when they're going to smash the price, or when they're going to, you can it gives you an edge to identify inflection points. So like, for example, if you're coming up to a major resistance level and you're technically stretched, the RSI is above 70, and you look at that commitment of traders report and you see the commercial banks are heavily short, there's a really good chance that, they're going to come smack the price in the paper market and see a sharp, a little drop downwards. So that's kind of how I think about it.
And in a way, you're still just basically charting human behavior. Is that right?
Yeah, exactly. I mean, it's price and volume overlaid on a chart, to me, is the most information dense source of market information out there. So it's literally telling you what's happened. And when it comes to manipulation, that's where I don't listen to what these bankers and Wall Street people say. I watch what they do. And when it comes to a price chart, they can't cover their tracks. Price and volume is going to leave tracks on the chart. So you can kind of see what the institutions and the big money is doing, to include the manipulators.
Excellent. What else do you have for us, Steve?
Well, just a couple more charts here. And this is kind of like my big picture chart. I love this chart. It goes back to 1980, and it measures the CRB index, which is a basket of commodities, versus the S&P 500 going back to 1980. So about 40 years of data here. And what we see is that commodities are ridiculously undervalued relative to the S&P 500. And what's interesting is when things like this turn, they typically don't just revert to the mean. When something's so far out of whack, it typically overshoots the mean and goes to the opposite side. So if and when this turns around, which I think is happening right now, I think we're going to see a multi-decade commodity bull market that is, I don't want to say unprecedented to sound dramatic, but I think a lot of money is going to be made in the next commodity bull market. And I think we're in the early stages of that.
So, Steve, do you have any, let's say, historical context to really try and understand why since 1980, this chart just continues pretty much all the way down into present day?
So if I hear you correctly, you're asking like, why is this happening, right?
Yes. From let's say specifically 1980.
Well, let's see. I really don't. I mean, that's kind of one of the beauties of being looking at charts is you don't always have to know the reasoning why. I mean, you could come up with all kinds of reasons. In 1980, we had just finished a big commodity bull market and stocks had bottomed. So that's why that's a key inflection point right there. But why this has lasted 40 years, gosh, I don't know. I mean, it's pretty perplexing to say why have commodities underperformed for 40 years?
Mm-hmm. Yeah, that's a great point.
And I just have a couple of charts here. We like to talk about precious metals, but we also cover the uranium sector. And uranium has just been on fire lately. A lot of these mining stocks are up, several 100% just in the past few months. But I do think, a big question we get a lot is, how is it too late to participate in this bull market? And my answer is a resounding no. I think we're still in the pretty early innings. It's not inning 1 or 2, but maybe inning 3 or so. And what we have here is a long-term chart of the price of actual uranium. And you can see just back in 2007, price got up to like $140 a pound, albeit that was a brief spike, but that price and volume is still on the chart. And price did trade up near $95 for a little bit longer period of time. And here we are down at 30. And what's interesting about the uranium market is that spot price is going to have to rise to at least $50. And that's being very conservative to incentivize the new production that's going to be needed to bring all these nuclear reactors online. Nuclear is a growth industry, and there's going to be a lot more uranium that's needed to supply these reactors. And $30 uranium just isn't high enough to incentivize that production. So $50 is like the very low end conservative target. And we're still down here at 30.
Steve, in any of your discussions around this uranium spot price, have you gotten a feeling for when that next, let's say, contract cycle is due to kind of start to be negotiated for more silver silver on the mind, more uranium supply?
No, but I'd say that's kind of the $1 million question. And you can almost make a case that some of these utilities are almost negligent that they haven't began that contracting cycle, especially with recently we just saw that Sprott took over the physical-backed fund, Uranium Participation Corp.
Mm-hmm.
That hasn't gone into effect yet, but I think that's going to just create a lot more demand for physical metal, for physical uranium, and that's going to be obviously be more competition for these utilities and be just another tailwind for the sector.
Yeah, great point. So you also have a Cameco chart for us as well, right?
Yeah, and this is the last chart I put together, and I used Cameco because it's kind of like the bellwether of the uranium sector. It's a large cap stock, and this chart here goes back to 2007. And what's interesting is 3 months ago we broke above this long-term downtrend line, which is now support. And so we broke out above it, came back and back tested it, and here we are rallying nicely. And whenever we get a breakout, like I said before, my eyes go to the bottom of the chart to see if volume confirms. And this is all-time record buying volume in Cameco. And we see a similar story in a lot of the other stocks as well, but Cameco is the one I highlighted here. However, when you come up to the top of this chart here, you see the RSI is getting pretty stretched technically. So it would actually be healthy to see a little bit of backing and filling here, some consolidation, maybe even a pullback. But I think the trend is certainly now up. And I expect higher highs and higher lows going forward across the sector in uranium.
Is there any, again, historical context, Steve, for Cameco maybe leading the spot price out of the bottom?
That's a really good question. I don't have any hard data on that, but in general, you see that in commodity bull markets where kind of the larger cap names lead and then the more speculative components kind of follow suit. So I think that is a reasonable conclusion that Cameco is leading the charge here and some of the juniors are likely to follow suit.
Interesting. That was it for the charts you have for us, Steve?
It is, yeah.
Excellent. Do you have anything else that you'd like to leave our listeners with before we wrap up here?
Not really, Tom. I mean, it's always a pleasure coming on and chatting with you. I could talk for hours about commodities and silver and gold, and it's kind of cool having the opportunity to come on and share my thoughts. Because for years this was kind of a lonely road. Not many people want to talk about silver and gold around the office or whatever. So thank you for having me on. Is what I'm trying to say.
Absolutely, Steve. And of course, you're on Twitter at SilverChartist, and as we see on silverchartist.com as well.
That's correct. Yep.
Perfect. Thanks so much for your time today, Steve.
Awesome, Tom. Thanks so much.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.